Welcome back to Talk Tickers, the show where we cut through the noise of earnings season to bring you the numbers that actually move the tape. It is Tuesday, January 27th, 2026. Today, we are opening up a file that, at first glance, looks like a crime scene, but might actually be a masterclass in financial engineering.
We are talking about Bank of Marin Bancorp, ticker BMRC.
It's definitely a ticker that woke everyone up this morning. You open the press release and, the first number you see is a GAAP net loss of $39.5 million. For a regional bank of this size, that is a staggering amount of red ink.
It's ugly. I mean, we are talking about a negative $2.49 per share. Usually when you see a print like that, you expect the stock to get taken out to the woodshed.
Oh, absolutely.
You'd expect a double-digit sell-off, panic in the forums, the whole 9 yards, but that isn't what happened.
No, quite the opposite. The stock actually rallied. It closed up 3.75% at $27.41. So the market looked at a nearly $40 million loss and decided to throw a party. This is exactly why we do this show, to explain why the headline number is lying to you, or at least why it's not telling the whole story.
It comes down to distinguishing between, an operating failure and a strategic reset. If a bank loses money because loans are going bad and depositors are fleeing, that's a disaster. But if a bank loses money because they are voluntarily cleaning up their own balance sheet to maximize future earnings, well, the market tends to reward that. And BMRC just delivered a textbook kitchen sink quarter.
Let's break down the actual performance before we get into the heavy financial engineering. Because I want to be clear, investors weren't just buying a story, they were buying an earnings beat, right?
That's right. If you strip out the one-time charges associated with the restructuring, which we will get to, the adjusted earnings per share came in at 59 cents.
And the street was sitting at 51 cents.
Exactly. So that is a massive beat, roughly 16% ahead of consensus. And it wasn't just cost cutting. Net revenue hit $34.2 million, which also came in ahead of expectations. So operationally, the engine is running hot.
They also declared the dividend again, 25 cents a share.
83 consecutive quarters.
Yeah.
That is a streak you don't break lightly. By maintaining that payout, even while posting a GAAP loss, the board is effectively signaling, we have plenty of capital, this loss is on paper, and the cash flow is fine.
Okay, so the core business is healthy. But we have to address the elephant in the room. You don't lose $40 million by accident. This was a balance sheet restructuring. Walk me through the mechanics here, because I think a lot of people see security sale and get flashbacks to the 2023 banking crisis. How is this different?
It's the same mechanic, but a completely different context. BMRC held a massive portfolio of bonds, about $816 million worth in their held to maturity, or HTM bucket.
Ah, the famous HTM bucket. The place where banks hide losses because they don't have to mark them to market.
Precisely. As long as you don't sell them, you can pretend they are still worth 100 cents on the dollar, even if they are yielding 1% in a 4% world. But here's the problem. Accounting shields don't pay the bills. Those low-yielding bonds were dragging down their net interest margin. They were dead weight.
So management decided to stop pretending.
They shattered the glass. They moved those securities to available for sale and sold about 74% of the legacy portfolio. The book value was over $590 million. By selling them at current market prices, they crystallized a pre-tax loss of $69.5 million.
That's a painful check to write.
It is, but think about the opportunity cost. They took the cash from that sale and reinvested it. Those old bonds were yielding next to nothing. The new securities they bought are yielding 4.26%.
So they traded a 1% or 2% asset for a 4.26% asset.
And that spread difference is pure earnings power. Management projects this move alone will add 40 cents of EPS accretion over the next 12 months. It effectively supercharges their net interest margin by 25 basis points overnight.
I get the logic of swapping low yield for high yield. That makes sense. But here's where I get skeptical. Usually when a bank realizes a $70 million loss, it punches a hole in their capital ratios. They have to fill that hole. Typically that means issuing stock, diluting the shareholders. But I didn't see a secondary offering here.
And that is the brilliance of this specific execution. They didn't dilute the equity. They filled the capital gap by issuing $45 million in subordinated debt.
Okay, hang on. I'm looking at the numbers here. They issued sub-debt at a 6.75% coupon. But you just told me they are reinvesting the bond proceeds at 4.26%.
Correct.
So they're borrowing it at 6.75 to earn 4.26. That sounds like negative carry. That sounds like a way to lose money, not make it. How does that help the shareholder?
It sounds counterintuitive, I know, but you have to look at the cost of capital hierarchy. Yes, the debt costs 6.75%, but what is the cost of equity? If they had issued common stock to fill that hole, they would have permanently diluted the earnings per share. They would be slicing the pizza into more pieces forever.
Right, because once those shares are out there, they are out there.
Exactly. By using sub-debt, yes, they have an interest expense line item. But the tax shield helps, and more importantly, the math works out such that the income from the new higher-yielding bonds offsets the cost of the debt, plus the legacy portfolio drag is gone. They calculated that even with the 6.75% interest cost, the transaction is immediately accretive to EPS.
So they're paying a premium on the debt side to protect the equity side from dilution.
That is the key. They preserved the tangible book value per share and the future earnings power for the existing holders. It's sophisticated capital allocation. It's admitting, we made a mistake buying those low-yield bonds years ago, but we are going to fix it without asking you, the shareholder, to pay for it with dilution.
That's a grown-up move. It's admitting the mistake and fixing the engine without stopping the car. But you can't just financial engineer your way to prosperity forever. Eventually, you have to actually be a bank. You have to lend money to people who pay you back. How did the lending side look?
This was the second pillar of the bull case. If the restructuring was the defense, the loan growth was the offense. And the offense is scoring. Total loan originations hit $141 million in Q4.
Is that a lot for them?
The CEO, Tim Myers, flagged it as one of the strongest production quarters in the last decade. And remember, we are in an environment where a lot of banks are pulling back. They are tightening standards. They are scared of the economy. BMRC is out there writing checks.
And it's not just mortgages, right?
Over 90% was commercial lending. That is the bread and butter, high-quality business loans.
But I have to play devil's advocate here.
Yeah.
Usually, when a bank has a decade-best quarter in volume, it means they emptied the pipeline. They hustled to close everything by December 31st to make the bonus numbers, and then January is a ghost town.
That is the typical pattern, pulling forward demand. But management explicitly stated that the pipeline, the deals they haven't closed yet, is 30% higher than it was a year ago.
Even after closing $141 million.
Even after the record closings, they have refilled the funnel. And it's interesting to see where it's coming from. It's not just their home turf in Marin County. They highlighted significant wins in Greater Sacramento and the East Bay.
That tells me the new hiring strategy is working. They lifted teams out of other banks in those regions, and those bankers brought their Rolodexes.
It proves the brand travels. They aren't landlocked. And frankly, Sacramento is a slightly different economy than the Bay Area, provides some nice diversification.
Okay, let's talk about the fuel. You can't lend $141 million if you don't have the cash. And for the last 2 years, the story in regional banking has been the war for deposits. Everyone is fighting for cash.
This might be the most shocking number on the sheet. Deposits grew by $33 million.
Growth is good. But at what cost? Because I can grow deposits tomorrow if I offer a 6% CD.
That is the miracle. Their cost of deposits actually went down. It dropped 10 basis points to 1.19%.
1.19%. I can get 4.5% in a money market fund right now. How on earth are they keeping their cost of funds at 1.19?
It's the mix. They have a massive percentage of non-interest-bearing deposits. About 43.7% of their total deposits pay zero interest.
These are operating accounts.
Exactly. It's the local construction company that needs $500K in the checking account for payroll on Friday. It's the title company moving cash for closings. That money isn't rate sensitive. It's utility money.
That is the holy grail. While other banks are seeing that money flee, BMRC is holding on to it. That explains why their margin is expanding while everyone else is getting crushed.
It validates the franchise value. You can't replicate that deposit base overnight. It takes decades of relationship banking to build a book where 44% of your customers give you money for free.
All right, we've covered the restructuring, the loan growth, and the deposits. Now we have to look at the risks. We cannot have a conversation about a regional bank in 2026 without talking about credit quality, specifically commercial real estate. Everyone is terrified of the office apocalypse.
It's the shadow hanging over the sector. But BMRC actually posted a significant improvement here. Classified loans dropped by 35%. Non-accruals are down to 1.27%.
That is a sharp drop in problem loans. Was there a specific catalyst for that?
There was a great anecdote from the call regarding a property in Palo Alto. This was a legacy pandemic issue, a commercial property that had gone 100% vacant, a total ghost town.
That is usually where the story ends, with a foreclosure and a write-down.
Right. But they stuck with it, and now it is 100% leased. They have tenants signed. Management noted it's currently rated special mention, which is like a watch list. But as soon as those tenants physically move in, it upgrades to a pass rating.
That's a win. But one building in Palo Alto doesn't fix the whole market. Did they signal any new trouble spots?
They did. And this is where we need to connect the dots to the broader economy. They downgraded a credit in the wine industry.
Which makes sense. Bank of Marin, they're going to have exposure to Napa and Sonoma.
Exactly. And this wasn't just about one bad borrower. They made some broader comments about the wine industry struggling. Sales are down, visitation to tasting rooms is softer, the revenge travel boom has faded, and people are buying less premium wine.
So while the tech sector in Palo Alto is recovering, the agricultural luxury sector is taking a hit.
It's a reminder of idiosyncratic risk. You can worry about office towers all day, but sometimes it's the vineyard that gets you. However, because BMRC's capital position is so strong now after this restructuring, they can absorb a few bruises in the wine portfolio without panicking.
Let's zoom out to the 2026 outlook. We have a cleaner balance sheet, a lower cost of funds, and a growing loan book. What is management telling us to expect for the rest of the year?
The arrow is pointing up on net interest margin. It already jumped 24 basis points to 3.32% this quarter. They are modeling for the Fed to ease rates by maybe 25 to 50 basis points later this year.
Which, given their deposit structure, probably helps them.
It helps reduce the pressure on that tiny slice of interest-bearing deposits they do have. But they did issue a warning about Q1 seasonality.
Right, the don't panic disclaimer.
They were very clear. Q1 usually sees deposit outflows. It's just the cycle of their business clients paying year-end bonuses and tax bills. So if we see the deposit number dip in April, it's not a run on the bank, it's just the cash cycle.
But the most interesting part of the outlook for me was the M&A commentary. For the last 18 months, BMRC has been in defense mode. Now, they sounded aggressive.
They explicitly mentioned that a recovering stock price makes M&A more feasible.
They want to buy.
They are positioning themselves as a consolidator. Think about it. There are dozens of smaller community banks in Northern California that didn't do this restructuring. They are sitting on massive unrealized losses. They are paralyzed. They can't lend.
And here comes BMRC. Clean balance sheet. Stock trading up.
They can use their stock as currency to acquire those paralyzed banks. They can roll up the market. This restructuring was a clearing event that allows them to switch from prey to predator.
That is a powerful narrative shift. You go from surviving to conquering. It explains why the market looked at that $40 million loss and bought the stock. They weren't buying the past. They were buying the future optionality.
It really is a case study in transparency. The market rewards management teams that rip the Band-Aid off.
All right, that brings us to the segment where we stop being analysts and start being, well, creative opportunists.
Disclaimer time.
Absolutely. This is the Not Financial Advice segment. We are not your financial advisors. We are two voices in your headphones. Do your own diligence. Don't trade your rent money based on a podcast.
But if we were pitching a trade to a high-risk desk based on this call, what is the play?
I'm fixating on that wine industry comment. I'm calling this trade the Napa Valley Vulture.
A vulture play. I'm listening.
Okay, connect the dots. We know the wine industry is struggling, cash flow is tight, loans are getting downgraded. That means there are distressed assets out there. Premium vineyards, wineries, maybe even small family-owned banks heavily exposed to Act Direct that are bleeding.
And BMRC is sitting there with a war chest.
Exactly. BMRC just cleaned house. They have capital. They have a mandate to grow. I think the trade is to go long BMRC, not just as a bank, but as a proxy for distressed asset consolidation in wine country.
So you're betting they use that liquidity to scoop up prime assets at pennies on the dollar.
While other lenders are scared and foreclosing, BMRC steps in. You're buying a distressed asset fund disguised as a regional bank. If they pick up the right assets during this downturn, the ROI in 3 years could be massive.
I like it. It leverages their local knowledge. My trade is a bit more technical. I'm calling it the sub-debt arb.
Let's hear the math.
It's a pair trade. You go long BMRC and you short the zombie regionals.
I love that term, zombie regionals.
You know who they are. The banks that have the exact same problem BMRC used to have, huge HTM losses, but haven't taken the medicine. They're just sitting there earning nothing, hoping the Fed cuts rates to zero to save them. They are the walking dead.
They are paralyzed by accounting optics.
Right. BMRC paid that $675 on the subdebt to unlock their stock price. They proved that action creates value. The zombies are going to bleed slowly, their margins will compress, their best lenders will leave, and their stock will drift lower.
So you short the paralysis and you long the action.
Exactly. You capture the performance gap between a management team playing to win and a management team playing not to lose. BMRC has stopped the bleeding, the zombies are still hemorrhaging.
That is sharp. It really highlights the theme of this entire episode. The market prefers an ugly truth over a pretty lie. BMRC told the ugly truth, paid the price, and now they are free to run.
It raises the question for every investor holding a regional bank stock right now. Is your management team fixing the problem, or are they just hiding it in the footnotes?
A question worth asking before the next earnings print hits the tape. We'll leave it there for today. Talk Tickers signing off. See you in the market.